Rates are volatile, inflation is back in the headlines, and the conflict in the Middle East is shaking up markets. So how should investors rethink fixed income, and where can you find income without taking on too much risk? We're going to talk about all that and more right now on UBS Trending. Hi, everyone, and thank you for joining us. I'm Anthony Pastore, and this is UBS Trending. Brian Whalen, who is the Chief Investment Officer from TCW Fixed Income Group, is joining me in the studio. Brian, nice to see you.
Nice to see you. Thanks for having me.
Yeah, so we're in the midst of a lot of volatility, and really the big word that keeps coming up again is uncertainty related to what's happening with the Iran conflict. And we're here to talk about fixed income today, which, you know, if you look at the way rates have been moving, we were just talking about this before we started filming today, which is that there has been some volatility in the rates market when you're looking at 10 years, 2 years, 30-year treasuries. So why should investors sort of be rethinking the way that they consider fixed income in their portfolio today, given what we know and especially what we don't know?
Yeah. So first, I would say, you know, there's been a lot of noise. Markets have moved gyrated. Investors are reacting to every tweet coming out of, you know, the Oval Office. So I think, first of all, you want to kind of ground yourself on your views of the world before this volatility that was induced by the war. And then also kind of look at like what's changed, you know, over the past 30 days. So, you know, we had some slides here. I just want to walk through, just kind of set the landscape with regards to like what's happened. So interesting reaction. So we have a war. You think potentially headwinds to growth. You think that should be good for bonds. But as you can see across the developed world here, we've seen a jump in interest rates. Nothing like we saw in 2022 and 23, but somewhere between like 35 and 80 to 90 basis point jumps across the globe. And so, what does this tell you? Initially, it's the market's reaction saying that, you know, its primary concern and kind of the first order effect is with regards to inflation.
Right.
And so, oil up, energy prices up, inflation. You know, and we are human beings. You know, we talked about human psychology a bit earlier, you know, before we went on air. And, you know, we all have a recency bias. And so investors' recency bias is what happened in 21, 22, 23. Well, inflation spiked up. Now, the problem then was that, you know, back then there was a supply issue. There was a lot of money flowing through the system. There was COVID stimulus, and people went out and spent this money. We're in an opposite period of time. So, you know, with regards to right now, it seems like, you know, rates seem interesting and a good buying opportunity to us.
Well, the funny thing is you're right about the recency bias. It actually makes sense. And, you know, when we look at, you and I and my team, we all look at charts all day long. We can go back 1 year, 2 years, 5, 10. And then, you know, you're thinking about what happened during the 2008 and 9 financial crisis. Yeah. Then COVID and the aftermath, of course, which we had, you know, tanker ships still sitting in the oceans waiting to come to port because of all the issues with nobody being able to actually receive those goods. So we do feel that, and I think the price of gasoline, which is what everybody talks about when you're sort of having dinner with your friends or family, is everybody's talking about $5 plus, you know, per gallon, you know, and some places it's $4. But you know, the question then is about seeking income for an investor, because we also have to prepare for what the Fed might do, because, you know, they have a dual mandate, jobs and inflation, and now, you know, job growth might be waning a little bit, but inflation has an opportunity to, at least in the short term, spike a little bit. So how do you seek income in this market?
So let's break the conversation two pieces. We'll talk about interest rates and duration, and we can talk about credit products and spread durations and all those interesting words we use in the fixed income market. So first of all, I'd say with regards to interest rates, and we saw that chart about the jump in rates. So, you know, well, we have a little saying around the office, you know, traders look to kind of first order effects and investors are looking at second order effects. So the first order effects it's the easy button. It's, okay, energy's going up, so inflation is going to go up, and therefore interest rates need to go higher. We would pause right there and say, you know what, more likely than not, the developed economy, maybe outside of Australia, isn't in a position to pass through these energy costs and create long-standing inflation. So rather, the second order effect is that these energy costs are just going to act like a tax on consumers. So generally speaking, unless you have a very, very large, you know, net worth and you're investing in the stock market, et cetera, you are feeling these effects. And every dollar you have to pay at the pump is a dollar you're not going to spend in regular kind of services and goods. And so, you know, we're looking at this world right now, interest rates, it's a great opportunity. I would remind everyone out there, you know, you think about these recent reactions when you have concerns about a headwind to growth. COVID was the great last example. Now, I remember, generally speaking, when I think of that time period, rates rates came down. Interest rates came down because of the growth headwind. However, for the first couple weeks, rates actually jumped in the Treasury market. Why is that? Probably the reason we've seen those rates jump today, which is Treasuries, the largest liquid asset class in the world. Why did rates go up? Well, maybe because inflation fears are popping up, but also there are large sovereign holders of treasuries that needed liquidity.
Yeah.
A lot of the countries that were most affected by this war, we have now seen some data suggesting they went out and sold treasuries to create cash to basically spend in their economy and on their infrastructure, which has been destroyed. And so to see rates jump up 30, 40, 50, 60 basis points, you know what? That makes sense, but that's the short-term impact. The long-term impact, we think, will be these high energy costs weighing on the consumer, weighing on growth, which should lead to most developed countries, including of our own, our central banks not hiking rates like a lot of the pricing has become, but actually getting back to cutting rates as we get into the second half of the year.
Right. And as we're sitting here, we haven't seen the March CPI data come out just yet. So it'll be really interesting to see how much inflation could tick up in just this short amount of time. But we have seen prices go up in a short amount of time. Look, traveling by air, if you book now, or even I was looking, some of the cruise lines are also warning that prices are going to be up. Fuel costs are what they are. So if you kind of look beyond the Fed and all the things that the Fed is looking at, how do you then, look at the fixed income market today? It's hard to take the Fed completely out of the equation. How can you look at that without thinking about what the Fed might have to do?
Well, look, I think the Fed's probably going to pause for a little bit. They said they're going to see how these
wait and see is what
wait and see.
Powell
They're going to
just
see
said.
how these energy costs are they passed through in terms of everything in our economy prices are going up, or just little segments. If it's just little segments, they don't have an inflation problem. And so how we kind of think about the world is, okay, once we get through the volatility caused by the war, what are we left with?
Yeah.
So let's think about where we were at the beginning of the year. What did we have? So we had, on the positive side, we had fiscal policy becoming a tailwind. Like last year, we had immigration policies shrinking the supply of labor. We had DOGE. We were shrinking the federal footprint. That weighed on growth, right? We had the tariff volatility and what that did to consumer confidence. So that was actually a headwind for growth.
Yeah.
2026, the big beautiful bill, individual tax incentives, deregulation, corporate tax incentives, those are all positives. That's on one hand. On the other hand, we've had a stalled labor market here in the U.S. We continue to have these monthly revisions. And so what it looks like to us, our labor market looks like it's flatlining. We continue to see these revisions. Remember the whole thing about labor hoarding after the pandemic? Well, we're kind of seeing the other side of that. There is no wage pressures. So consumers are comfortable, companies are comfortable, maybe turning over their workforce. You can see here total job growth by year. Just look at the trend. We finished 2025 with basically flat type of job growth. And by the way, AI, everybody's favorite topic right here. A couple of years ago, we didn't talk about AI creating layoffs. We're at the point now, the inflection point, AI is becoming so powerful and it's changing every month. Like the reality is that for the next 5 years, our economy is going through a transformation where maybe we don't need as much labor as we have previously. And so we're at this point in time where we've got strong tailwinds from fiscal policy, marginal labor market that is kind of teetering on the edge. And then we have this final piece that the market was really focused on before the war, which is AI, private credit, BDCs, basically a decade and a half of disintermediation where capital moved from big banks to the private sector. And what it feels like and what the market was starting to kind of sense right before the war, which was, this private credit story may have gone too far. There's probably been some underwriting that shouldn't have happened. Jamie Dimon's famous cockroach comment about, you see one, there's probably more. There probably is. So, even if this war ends today, we think for the rest of the year, we will have periods of volatility, not because of what happened in the Middle East, but basically we're going to pick up this baton and see kind of a labor market teetering on the edge, complicated by this really shifts of capital from private credit, probably back to the public sector.
Right. Yeah. I think we have to remember that those stories that you were just referring to with private credit, obviously the slowing job growth, AI, those were all happening from January 1st until when the war began. So those stories haven't really gone anywhere. They've just had to go off to the sidelines a little bit as the headlines are more focused on what's in the immediate. AI, although that's a huge story, and we're actually seeing growth and adoption of AI way faster than anyone had expected. So probably this shift in this slowdown in job growth and is probably a little bit of a surprise to most because we weren't expecting AI to be so, ingrained in every single company's bottom line this quickly.
It is a productivity miracle.
Yeah.
It will transform the way we all live our lives. It is an incredibly positive thing for humanity over the long term. But let's not forget one of those key terms we all used back in undergrad school, which is creative destruction. We are in the midst of a period of creative destruction where our economy does not need as many employees. The labor force does not need to be big. And we have to go through a period of time. It's probably going to be a couple years where, these segments of workers that aren't needed anymore and going to be replaced by AI, they're going to have to step back, maybe get retrained, and then kind of put in other parts of the economy. That creates disruption. That creates economic headwinds. As an investor, I would say that creates opportunity.
Yeah, and hopefully it's more along the lines of short-term pain for long-term gain. On the AI story specifically, I should clarify.
Certainly.
All right, so we only have about a minute left. I just wanted to get you, we've already gone through some of the places you see opportunities.
Yeah.
What are the risks? What are the most, sort of untapped opportunities in fixed income right now for the average investor?
Sure. Maybe I got a chart on here with some bars, looks at securitized markets versus the credit markets. I'm going to bring up some terms that we'd like to talk about right here. So I'm going to keep this simple.
Yeah.
Green good, bad, blue bad. So the green is our securitized market. That's agency mortgage-backed securities, commercial mortgage-backed securities, asset-backed, and blue is corporate credit, investment-grade corporate high yield. And what you will see here is that nothing's cheap. So the average kind of price right there in spread terms is that blue line. So nothing's cheap, but we're all in a relative world, and we got to put our chips somewhere. So what we like to do is buy the green, be underweight the blue, and I'm going to use some terms here that we're thinking right now. Clearly, we have a cautious outlook on the economy. We think there's disruption coming. There's going to be movements in spreads, and some sectors are going to have some pain. Software is an interesting sector that's undergone some pain. So what we like to talk about is two terms here, bendable versus breakable. We like to buy fixed income bonds where the conversation is never about loss of principal, it's just mark-to-market hit. That's bendable, meaning they will always, this is the second term, they will always mean revert. So if you have a bendable asset that will not default, its price might go down a little bit just due to market volatility, but that creates opportunities because what it mean reverts to is always back to par.
Right.
So when we look at charts like this, we look at the green, these are high-quality assets. They will always pay back at par. It's not a question of if, but it's a question of when. And when you get opportunities to add a little bit of those green bars in a month like March, that's what you do because over time, that's how you kind of generate good income for a fixed income portfolio without, to your point earlier, not having to take on a lot of duration risk.
Excellent. Brian, thanks so much for being here. Great conversation. Very timely given everything that's happening in the markets right now. Good to see you.
Good to see you. Thanks.
Please come back again.
Will do.
And thank you again for joining us, everybody. There's a lot more information from our great partners like TCW and others, and including our own CIO here at UBS at our Insights website, ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. You can also follow the studio at our dedicated Instagram channel at UBS Trending. So give us a follow there. And as always, if you have any questions about what Brian and I just spoke about today, please make sure that you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.